Before we dive in, a quick but critical disclaimer. I am not a financial advisor, a CPA, or a tax attorney. This video is for informational and educational purposes only, and should not be considered legal or financial advice. The world of cryptocurrency and taxes is complex and constantly changing. Please consult with a qualified professional for advice tailored to your specific situation. You bought some crypto. Maybe it was Bitcoin, maybe Ethereum, maybe a long-shot altcoin your buddy swore was the next big thing. You put in a few $100, maybe a few thousand, and it worked. It actually went up. You decided to cash out some of your winnings. A nice clean $1,000 profit. You felt like a genius. You took your partner out for a nice dinner. Maybe bought that new gadget you've been eyeing. And then you forgot about it. A year goes by. Then two. And then a thick official-looking envelope shows up in your mailbox. It's from the Internal Revenue Service. Your heart sinks. You open it, and your eyes scan a page of dense, intimidating text filled with words like deficiency, penalty, and failure to report. Suddenly, that $1,000 profit from 2 years ago has morphed into a $10,000 tax nightmare of back taxes, interest, and penalties. You're staring at the letter, confused, angry, and terrified, asking yourself one simple question. How on earth did this happen? This scenario isn't just a scare tactic. It is the reality for a rapidly growing number of Americans who are navigating the wild west of cryptocurrency, completely unaware of the tax landmines hidden under their feet. The IRS isn't playing games. They have a checkbox on the front of the 1040 tax form, asking every single American if they've dealt with digital assets. They're partnering with crypto exchanges to get user data. They see a $1 trillion industry and they want their cut. The problem is they've made the rules so confusing, so counterintuitive, that most people are setting themselves up for disaster without even knowing it. You think you're safe because you only traded one crypto for another? You're not. You think that NFT you flipped is just a hobby? The IRS sees it as a taxable event. What about staking rewards? Airdrops? Using crypto to buy a pizza? Every single one of those actions is a potential trapdoor leading to a tax headache you can't even imagine. But it does not have to be this way. The goal of this video is to pull back the curtain and demystify how the United States government actually taxes cryptocurrency. We are going to cut through the noise, the jargon, and the fear. We're going to give you a simple foundational framework that will empower you to understand your obligations, make smarter decisions, and sleep soundly at night, knowing you won't be getting one of those dreaded letters from the IRS. We're not going to read you the tax code. We're going to give you the mental models, the core principles that govern everything. By the end of this presentation, you will understand more about crypto taxes than 99% of investors out there. You will know what a taxable event is, why it happens, and how the IRS looks at your digital assets. This is the knowledge that separates the smart investor from the future victim of an audit. So, let's start with the single most important piece of information you need to understand. If you grasp this one concept, everything else will click into place. Are you ready? Here it is. In the eyes of the IRS, cryptocurrency is not currency. It is property. Let me say that again because it is the absolute bedrock of this entire system. The IRS does not view your Bitcoin like it views a US dollar. It views your Bitcoin the same way it views a stock, a bond, a house, or a valuable piece of art. It is property. This is a massive distinction, and it's the source of almost all the confusion. When you spend $1, it's just a transaction. You buy a coffee for $5, you give them a $5 bill, you get the coffee. End of story. There's no tax implication. But when you dispose of property, the government wants to know if you made a profit or a loss on that property. If you buy a share of Apple stock for $100 and sell it for $150, you have a $50 profit, or what the IRS calls a capital gain. You owe tax on that gain. If you sell it for $75, you have a $25 loss, a capital loss, which can actually reduce your tax bill. The exact same logic applies to your crypto. Every single coin, every token, every fraction you own is treated as a piece of property with a specific value at the time you acquired it. When you get rid of it, and we'll talk about all the ways you can get rid of it in a moment, the IRS compares the value at that moment to the value when you first got it. The difference is your capital gain or your capital loss. That's it. That's the entire game in a nutshell. Let's use a simple, non-crypto analogy to make this crystal clear. Imagine you're a kid in the 1990s. You buy a rare rookie baseball card for $10. A few years later, you meet a friend who has a rare comic book that you really want. The comic book is currently worth $50. Your friend agrees to trade his comic book for your baseball card. You make the swap. You walk away with a comic book, he walks away with a baseball card. Did any cash change hands? No. So you wouldn't think there's any tax involved, right? Wrong. In the eyes of the IRS, what you just did was effectively sell your baseball card. You sold it for something worth $50, the comic book. Since you originally paid $10 for the card, you just realized a $40 capital gain. You, a kid on a playground, just had what the IRS calls a taxable event, and you technically owe the government taxes on that $40 profit. Now let's bring this back to crypto. It works the exact same way. Let's say you buy $1,000 worth of Bitcoin. A few months later, Bitcoin has a great run, and your holdings are now worth $2,000. You're feeling good. At the same time, you hear about a promising new crypto, let's call it Ethereum. You believe it has even more potential than Bitcoin. So you decide to trade your $2,000 worth of Bitcoin directly for $2,000 worth of Ethereum on an exchange. You never cashed out into US dollars. The money never hit your bank account. It just went from one crypto to another. So you're in the clear, right? Absolutely not. Just like the baseball card and the comic book, you just triggered a taxable event. You effectively sold your Bitcoin. What did you sell it for? You sold it for $2,000 worth of Ethereum. Since your original cost for that Bitcoin was $1,000, you have a $1,000 capital gain. And the IRS expects you to report that $1,000 of income on your tax return and pay taxes on it. This is the single biggest trap that new crypto investors fall into. They make dozens, even hundreds of trades swapping one coin for another, thinking they don't have to worry about taxes until they finally convert back to US dollars. But with every single one of those trades, they were racking up capital gains, creating a massive invisible tax bill that comes due on April 15th. So this brings us to the core question. What exactly is a taxable event? Based on this property rule, a taxable event is any time you dispose of your cryptocurrency. The four most common ways you do this are: 1. Selling your crypto for US dollars or any other government-issued currency. This is the most obvious one. You sell one Bitcoin for $50,000. That's a clear disposal. 2. Trading or exchanging one crypto for another. As we just covered, swapping your Bitcoin for Ethereum is a disposal of your Bitcoin. 3. Using your crypto to buy goods or services. This is the one that surprises a lot of people. Let's say you bought a Bitcoin for $10,000. Years later, it's worth $60,000. You decide to buy a $60,000 car and pay for it directly with your one Bitcoin. You might think it was just a simple purchase, but in the eyes of the IRS, you just sold your Bitcoin for $60,000 to the car dealership. You have a $50,000 capital gain from that transaction, and you owe taxes on it on top of the price of the car. Buying a coffee, a video game, or a plane ticket with crypto, it's all the same. Each purchase is a taxable disposal of your crypto asset. And 4. Receiving crypto from an airdrop or a hard fork. We'll get into the weeds on these later. But just know that getting free coins isn't always free from a tax perspective. So let's recap the foundational principle. The IRS sees crypto as property. Every time you sell it, trade it, or spend it, you are triggering a potential taxable event. You must calculate the difference between what you acquired it for and what you disposed of it for. That difference is your capital gain or loss. Understanding this single concept is the first and most critical step toward mastering your crypto taxes and protecting yourself from the IRS. It's the key that unlocks everything else we're about to discuss. So let's put that key to use. The first door we need to unlock is a massive, dangerous misconception that has cost people tens, even hundreds of thousands of dollars in surprise tax bills. It's the idea that you only have to worry about taxes when you cash out your crypto into good old US dollars. That as long as your money stays in the crypto ecosystem, bouncing between Bitcoin, Ethereum, Solana, or some new dog-themed memecoin, you're flying under the IRS's radar. This is completely, dangerously, 100% false. The IRS does not care if you ever touch dollars again. They care about something called a taxable event. A taxable event is simply a moment in time where the IRS says, "Okay, stop. Right there. We need to calculate if you made a profit or a loss." And these events happen far more often than people realize. For most people, there are 4 main types of taxable events you absolutely need to know. The first one is the one everybody gets. Selling your cryptocurrency for fiat currency like US dollars. You buy one Bitcoin for $30,000. A year later, you sell it for $70,000. You receive $70,000 in your bank account. The taxable event is the sale. Your cost basis was $30,000, Your proceeds were $70,000, so you have a $40,000 capital gain. Simple. Straightforward. This is the one that makes intuitive sense. But it's the next three that blindside people. The second, and by far the most misunderstood taxable event, is trading one cryptocurrency for another. Let's say you bought that one Bitcoin for $30,000. Now it's worth $70,000 and you think, you know what, Ethereum looks like it has more potential right now. So you go on an exchange and trade your one Bitcoin directly for, let's say, 20 Ethereum. In your mind, you didn't sell anything. You didn't see any dollars. You just swapped one digital asset for another. But in the eyes of the IRS, you absolutely did sell. They view this transaction as two separate steps. First, you sold your one Bitcoin for its fair market value at that exact moment, which was $70,000. That triggers a $40,000 capital gain on your Bitcoin, the exact same gain as if you had sold it for cash. Then, in the second step, the IRS sees you as immediately using that $70,000 to buy 20 Ethereum. Think of it like this. Imagine you have a classic Ford Mustang you bought for $30,000. It's now worth $70,000. You go to a dealership and you don't sell it for cash. Instead, you trade it straight up for a brand new Tesla. The dealer takes your Mustang, gives you a Tesla. No cash changes hands. Do you think the IRS just ignores the fact that your Mustang appreciated by $40,000? Of course not. They see you as disposing of your Mustang, and you have to recognize that $40,000 gain. Crypto-to-crypto trades are the exact same thing. Every single time you swap Bitcoin for Ethereum, Ethereum for Solana, Solana for a stablecoin like USDC, every trade is a taxable event. You are disposing of the first asset, and you must calculate your capital gain or loss on it at that very moment. This is the single biggest trap for active crypto traders. They might make 100 trades in a year, thinking they only have to worry about taxes when they cash out at the end, only to discover they triggered 100 separate taxable events and owe a mountain of taxes, even though their portfolio might be down by the time they realize it. The third taxable event is spending cryptocurrency on goods or services. This one also feels weird to people, but it follows the exact same logic. Let's go back to May 22, 2010. A programmer named Laszlo Hanyecz was hungry. He went on a forum and offered to pay 10,000 Bitcoin to anyone who would order him 2 large pizzas. Someone took him up on the offer, and the pizzas were delivered. That transaction is now famously known as Bitcoin Pizza Day. At the time, those 10,000 Bitcoin were worth about $41. So what was the taxable event? When Laszlo sent the Bitcoin, the IRS would view it as him selling 10,000 Bitcoin for $41 worth of pizza. Now, his cost basis in those Bitcoins was essentially zero since he mined them himself. So he would have had a $41 capital gain. It's a tiny amount, seems trivial. But what if you did that today? Let's say you bought one Bitcoin for $30,000. A few years later, it's worth $70,000, and you decide to buy a $70,000 car directly with your Bitcoin. You don't sell it for cash first, you just send the Bitcoin to the dealership. You have just triggered a taxable event. You sold your Bitcoin for a $70,000 car. You have a $40,000 capital gain, and you will owe taxes on that $40,000. Buying a cup of coffee, a computer, a plane ticket, if you use crypto to pay for it, you are technically selling that crypto for its fair market value, and you have to calculate the gain or loss. This is why spending appreciated crypto can be so complicated from a tax perspective. Now for the fourth category, which is a little different. This is when you earn cryptocurrency. This isn't a capital gain. This is treated as income. This includes things like getting paid a salary in crypto, earning rewards from crypto mining or staking, or receiving certain types of airdrops. The rule here is simple. When you receive the crypto, you have to recognize its fair market value in US dollars at that moment as ordinary income. So if your employer pays you $1,000 worth of Ethereum on payday, you report $1,000 of income on your taxes, just as if they'd given you a check for $1,000. The same goes for staking. If you're staking Ethereum and you receive a reward worth $50, that $50 is income. You have to report it. And here's the crucial second part of this. That income-generating event also sets your cost basis for the crypto you just received. So if you were paid $1,000 worth of Ethereum, your cost basis for that specific batch of Ethereum is now $1,000. If you immediately sell it, there's no capital gain because your proceeds equal your basis. But if you hold it, and it later appreciates to $3,000 before you sell it, you will then have a $2,000 capital gain, on top of the $1,000 of income you already reported. Earning crypto is a two-step process. First, it's income. Then, it becomes a capital asset just like any other crypto you buy. So to recap the four main taxable events: selling crypto for dollars, trading crypto for crypto, spending crypto on goods and services, and earning crypto as income. Now, just as important is knowing what is not a taxable event. Buying crypto with US dollars is not a taxable event. You're just acquiring the asset. This is where you establish your cost basis. Simply holding crypto or hodling is not a taxable event. Your portfolio can go to the moon and back down, but as long as you don't sell, trade, or spend it, you don't owe any capital gains tax. Moving crypto between your own wallets or your own accounts on different exchanges is also not a taxable event. You're just moving your own property from your left pocket to your right pocket. The ownership hasn't changed. Finally, gifting crypto to someone is typically not a taxable event for you, the giver, up to the annual gift tax exclusion limit. Understanding these triggers, knowing exactly which actions force you to calculate a gain or loss and which ones don't, is the foundation of a solid crypto tax strategy. It transforms you from a passive participant, waiting to be surprised by a tax bill, to an active manager of your own financial future. But knowing what triggers a tax isn't enough. The next equally critical question is, how much tax will you actually pay on those gains? Because a gain you made yesterday is not treated the same as a gain you made 13 months ago. The IRS has two completely different sets of rules and tax rates, and falling into the wrong category can literally double your tax bill. This is the difference between short-term and long-term capital gains, and it's the secret to legally cutting your crypto taxes in half. So how does this work? How can you legally slice your crypto tax bill in half? The answer lies in one simple concept: time. The IRS is obsessed with time. When it comes to your investments, they're basically holding a stopwatch, and the most important number on that stopwatch is 365 days. 1 year. Your entire crypto tax strategy can hinge on whether you hold an asset for 365 days or for 366 days. This one-day difference separates your profits into two completely different universes: the world of short-term capital gains and the world of long-term capital gains. Let's start with the one that trips up almost every new investor: short-term capital gains. The name is pretty descriptive. A gain is considered short-term if you sell or trade a cryptocurrency that you've held for 1 year or less. So, if you buy Bitcoin today and sell it 11 months and 29 days from now for a profit, that profit is a short-term capital gain. This is where the IRS hits you the hardest. Why? Because short-term gains are taxed at your ordinary income tax rate. Let me repeat that because it's critical. Short-term crypto profits are taxed at the exact same rate as the money you earn from your 9-to-5 job. Think about your paycheck. You know that percentage that gets taken out for federal income tax? Whether it's 12%, 22%, 24%, 32% or higher. That's the exact same rate that will be applied to your crypto profits. The government sees that quick crypto flip you made the same way it sees an extra shift you picked up at work. There's no special treatment, no discount, no reward. You're just adding that profit directly on top of your regular income, potentially even pushing you into a higher tax bracket. Let's make this real with an example. Meet impatient Ian. In January, Ian buys 1 Ethereum for $3,000. The market gets hot, and by August of the same year, just 8 months later, that 1 Ethereum is now worth $5,000. Ian gets excited, sees a quick $2,000 profit, and decides to sell. He locks in his gain. Now, let's say Ian has a regular job and his income puts him in the 24% federal tax bracket. Because he held that Ethereum for less than a year, his $2,000 profit is a short-term capital gain. So the IRS taxes that profit at his ordinary income rate of 24%. 24% of $2,000 is $480. That's the tax bill. Ian walks away with his profit, but nearly a quarter of it is gone, sent straight to Uncle Sam. He made money, sure, but he paid the maximum penalty for his impatience. This is the trap that catches so many people. They see green, they sell, and they don't realize until tax season that they chose the most expensive way to take a profit. Now let's look at the other side of the coin, the strategy that savvy investors use to build real wealth. Let's talk about long-term capital gains. This is where the magic happens. A gain is considered long-term if you sell or trade a cryptocurrency that you've held for more than 1 year. That's the key. Not 1 year exactly. It has to be 1 year and 1 day or longer. If you cross that 366-day finish line, the IRS rolls out the red carpet for you. They stop treating your crypto profit like a paycheck and start treating it like a true investment. And they reward you with drastically lower tax rates. Instead of your ordinary income tax rates, Long-term capital gains are taxed at three special, much lower rates: 0%, 15%, or 20%. Which rate you get depends on your total taxable income for the year. But for the vast majority of Americans, the rate is 15%. Let that sink in. By simply waiting a few more months, you could potentially drop your tax rate from 24% or 32% all the way down to 15%. In some cases, if your income is below a certain threshold, around $44,000 for a single filer in 2023, your long-term capital gains tax rate could be 0. That's right. You could have a $5,000 profit and pay absolutely nothing in federal taxes on it, all because you were patient. Let's go back to our example, but this time let's meet patient Penny. Just like Ian, Penny buys one Ethereum for $3,000 in January. She sees the price run up to $5,000 by August. But instead of selling, she holds. She understands the power of the one-year rule. She waits through the fall, through the winter, and into the next year. In February of the following year, a full 13 months after she bought it, she decides to sell. The price is still $5,000. She has the exact same $2,000 profit as Ian. But here's the game changer. Because she held for more than a year, her profit is a long-term capital gain. Let's assume Penny has the exact same job and income as Ian, putting her in the 24% ordinary income tax bracket. Does she pay 24% on her crypto profit? No, because it's a long-term gain. She gets the special 15% rate. So what's her tax bill? 15% of $2,000 is $300. Ian paid $480. Penny paid $300. On the exact same trade, the exact same profit, Penny kept an extra $180 in her pocket, simply because she waited a few more months. She reduced her tax bill by nearly 40% with the simple act of doing nothing. Now imagine this isn't a $2,000 profit. Imagine it's a $20,000 profit. For Ian, the short-term seller, a 24% tax is $4,800. For Penny, the long-term seller, a 15% tax is $3,000. That's an $1,800 difference. That's a mortgage payment. That's a vacation. It's a significant amount of money left on the table, all because of a date on the calendar. This isn't some loophole or a trick. This is the tax code literally rewarding you for having a long-term investment mindset. The single most powerful and simplest crypto tax strategy is to hold your profitable assets for at least 1 year and 1 day before you sell them. But this raises a critically important and often confusing question. What if you didn't buy all your crypto at once? What if you're like most people and you dollar cost average? Maybe you bought 0.1 Bitcoin in January, then another 0.1 in May, and another in September. Then, next year you decide to sell 0.15 Bitcoin. Which coins did you actually sell? Did you sell the ones from January, which are now long-term? Or did you sell the ones from September, which are still short-term? Or some combination of both? The answer determines your tax bill. And the IRS has a default way of calculating this called first in, first out, or FIFO. But that default method might not be the best one for you. In fact, choosing a different accounting method could save you even more money. Understanding how to calculate your holding period and your cost basis when you have multiple purchases is the next crucial layer of this puzzle. And it's where you can move from simply saving money to actively strategizing your tax outcomes. So let's imagine you're not just buying a single Bitcoin and holding it. You're doing what most smart investors do. You're dollar cost averaging. You buy a little bit every week or every month. 1 month, the price is $40,000. The next, it's $52,000. The month after that, it dips to $38,000. You've been doing this for a year. Your wallet now contains 12 different lots of crypto, all purchased at different prices. This collection of different purchase prices is your cost basis history. Now let's say you need some cash. You decide to sell half a Bitcoin. Here is the million-dollar question, or at least the question that could be worth thousands of dollars on your tax return. Which half a Bitcoin did you just sell? Did you sell the Bitcoin you bought at $40,000? Or the one you bought at $52,000? Your answer will radically change the amount of capital gains you have to report to the IRS. If you say you sold the Bitcoin you bought for $40,000 when the price is, say, $60,000, you have a $20,000 gain. But if you say you sold the Bitcoin you bought for $52,000, you only have an $8,000 gain. Same sale, same amount of money in your pocket, but a wildly different tax outcome. You can't just average all your purchase prices together and call it a day. The IRS doesn't allow that for property like cryptocurrency. They demand that you be able to specifically identify which units you are selling. This is where the strategy comes in. This is where you get to make a choice. The IRS gives you a few different accounting methods to choose from, and the one you pick can have a massive impact on your tax bill. The most common method, and the one that many exchanges and tax software programs default to, is called FIFO. That stands for first in, first out. Imagine your crypto purchases are like people getting in a line. The first person who got in line is the first person who gets to leave. With FIFO, the first crypto you ever bought is considered the first crypto you sell. So, in our example of you buying every month for a year, if you sell half a Bitcoin today, the FIFO method assumes you are selling the very first chunks of Bitcoin you bought 12 months ago. For most long-term crypto investors, especially in a bull market, this is often the worst possible option from a tax perspective. Why? Because your earliest purchases were likely at the lowest prices. By selling your oldest, cheapest coins first, you are guaranteeing that you realize the largest possible capital gain. You're maximizing your tax bill. Now, this isn't always bad. Maybe you want to realize those gains now, especially if they are long-term gains taxed at a lower rate. But you're still paying more in taxes this year than you might have to. So what's the alternative? Well, there's LIFO. Last in, first out. Think of LIFO like a stack of plates in your kitchen cabinet. You don't dig down to the bottom to get the first plate you ever put there. You take the one right off the top, the last one you added. With the LIFO method, when you sell, you are considered to be selling the most recent crypto you purchased. Let's go back to our example. The market has been trending upwards. You sell half a Bitcoin. With LIFO, you're not selling the cheap coins you bought a year ago. You're selling the more expensive coins you just bought last month and the month before. Because your cost basis for these coins is much higher, your capital gain is much smaller. You just gave yourself a significant tax break, simply by changing your accounting method from FIFO to LIFO. You sold the exact same asset for the exact same price, but you get to keep more of your money. But we can do even better. There is a third method, one that gives the investor the ultimate power to strategically manage their tax liability. It's called HIFO, highest in, first out. This is exactly what it sounds like. HIFO isn't about when you bought your crypto. It's about how much you paid for it. With this method, whenever you sell, you are considered to be selling the crypto for which you paid the highest price, regardless of when you bought it. You cherry-pick your most expensive purchase and sell that lot first. Let's say you bought Bitcoin at 40,000, 52,000, and 38,000. But 6 months ago, during a market frenzy, you bought a chunk at $65,000 right at the peak. Now the price is back down to 60,000. If you need to sell, the HIFO method lets you specifically sell that $65,000 Bitcoin. What happens? You bought at 65, you sold at 60. You don't have a capital gain at all. You have a $5,000 capital loss. And that loss is incredibly valuable. Not only do you pay zero taxes on that sale, but you can now use that $5,000 loss to offset other capital gains you might have. If you sold some Ethereum for a $10,000 profit, you can use your $5,000 Bitcoin loss to reduce that taxable gain down to just $5,000. You can even use up to $3,000 in capital losses per year to offset your regular income, like your salary from your job. HIFO is the ultimate tax minimization strategy for active investors. It allows you to harvest losses and strategically reduce your gains in a way that FIFO and LIFO simply can't. So FIFO, LIFO, HIFO. Which one should you use? It's not about which one is best, but which one is best for your financial situation. If you want to realize long-term gains now to clear them off your books, maybe FIFO is right. If you want to minimize your tax bill this year, HIFO is almost always the answer. But here's the critical, non-negotiable catch. To use any of these methods, especially the more advanced ones like LIFO and HIFO, you fall under the umbrella of specific identification. And to use specific identification, the IRS requires one thing above all else: records. You must have meticulous, bulletproof records. You need to be able to prove to the IRS, if they ever ask, the exact date you acquired each unit of crypto, the fair market value at the time you acquired it, the date you sold it, and the fair market value when you sold it. For every single transaction. If you have thousands of transactions across dozens of exchanges and wallets, this is a monumental task to do by hand. This is precisely why crypto tax software is no longer a luxury. It's a necessity for any serious investor. This software connects to your exchanges, tracks every lot you purchase, and allows you to model the tax impact of using FIFO, LIFO, or HIFO before you file, letting you choose the optimal strategy for your situation. Without those records, the IRS may default you to the FIFO method, potentially leaving you with a much larger tax bill than you needed to pay. So now you understand the core strategies. You know you can choose your accounting method to legally and ethically minimize your tax burden. You can use HIFO to sell your most expensive coins, generate tax losses, and use those losses to save real money. It feels like you've just unlocked a superpower. But what if I told you there's a hidden trap? A rule buried in the tax code, specifically designed to stop investors from doing exactly what we just discussed in certain situations. It's a rule that can turn your carefully harvested tax losses into dust. And for years, the entire crypto world operated under the dangerous assumption that it didn't apply to them. It's called the wash sale rule. And the IRS has made it increasingly clear that ignoring it could invalidate your strategies and put you squarely in their crosshairs. We're going to defuse that ticking time bomb in the next part. So, what is this ticking time bomb? In the world of stocks, it's a rule as old as the hills. For crypto, it was the Wild West loophole everyone thought would last forever. It's called the wash sale rule, and understanding it is no longer optional. It's critical for survival. Let's start with the basics. In the world the rule was designed for, the stock market. Imagine you buy 100 shares of a company, let's call it Future Tech, for $10,000. A month later, the market takes a nosedive, and your investment is now only worth $7,000. You're looking at a $3,000 unrealized loss. You think, hey, I can be clever here. I'll sell my shares, lock in that $3,000 loss to offset some of my other gains, and then immediately buy the shares back at the new lower price. I still own the stock, but now I have a tax deduction. It's a win-win. Wrong. The IRS saw that move coming a mile away about a century ago. They created the wash sale rule under Section 1091 of the tax code. This rule says you cannot claim a tax loss from selling a security if you buy a substantially identical security within a 30-day window. That's 30 days before the sale or 30 days after the sale. It's a 61-day window in total. If you trigger this rule, your loss is disallowed. Poof, gone. You can't use it to lower your taxes for that year. Instead, that disallowed loss is added to the cost basis of the new shares you just bought. So in our example, if you sold for a $3,000 loss and immediately bought back in, you can't claim that loss. Instead, the cost basis of your new Future Tech shares becomes their purchase price plus the $3,000 disallowed loss. All you've really done is kick the tax calculation down the road. The rule effectively prevents you from gaming the system by selling and repurchasing, just to create a tax deduction, while maintaining your position in a stock. For years, this rule was the bane of stock traders and the foundation of tax loss harvesting strategies. But crypto investors just laughed. Why? Because the rule as written specifically mentioned securities, things like stocks and bonds. And for a long time, the dominant argument was that cryptocurrencies like Bitcoin and Ethereum were not securities. They were property or commodities like gold or oil. And since the law didn't say commodities or property, the wash sale rule simply didn't apply. This was the golden loophole. It created a powerful, almost magical strategy for crypto traders. Imagine Bitcoin drops 20% in a single day. A trader could sell their Bitcoin, immediately claim a massive capital loss to wipe out other gains, and then seconds later buy that same Bitcoin back. They never lost their position in the market, but they generated a huge tax asset on paper. They could do this over and over again. It was tax loss harvesting on steroids, a financial cheat code that stock traders could only dream of. And for years people did it, and tax professionals even advised it, all based on this one critical interpretation. Crypto is not a security. But the IRS doesn't like loopholes, especially not ones that cost the US Treasury billions of dollars. They are an agency designed to collect revenue, and when they see a fire hose of potential tax dollars being diverted, they build a dam. And that dam came in the form of legislation and evolving guidance. The first major shot across the bow was the Infrastructure Investment and Jobs Act, signed into law in late 2021. Buried deep within this massive bill was a provision that explicitly sought to apply the wash sale rule to digital assets, the government's new catch-all term for cryptocurrencies. While the implementation of that specific part of the law has been delayed, the intent was made crystal clear. The party was over. The IRS was officially putting crypto traders on notice that they intended to close this loophole, and they had Congress's blessing to do it. This is where the ground gets incredibly shaky for anyone who continued to use the old strategy. The IRS has a powerful weapon: interpretation. Even without the new law being fully active, they can argue that some digital assets already function like securities. Or they can argue that the economic substance of the transaction, selling and immediately repurchasing to create an artificial loss, is a form of tax evasion, regardless of the asset class. Think of it like this. If you build a house right on a property line that has been in dispute for years, and then the government officially redraws that line and your house is now on their side, you can't just say, well, the line was blurry when I built it. They don't care. They'll send you the bill. So let's see what happens when this rule is applied to crypto. Let's say you bought one Ethereum for $4,000. It drops to $2,500. You decide to harvest that $1,500 loss. You sell your one ETH on December 15th. You feel smart. You just created a loss to offset the gains you made on that Dogecoin rally earlier in the year. But you still believe in Ethereum long-term, so on January 5th, just 21 days later, you buy one Ethereum back. You just triggered the wash sale rule. That $1,500 loss you thought you had? It's disallowed. You cannot use it on your tax return. And worse, that loss isn't just gone forever. It gets added to the cost basis of your new purchase. So, if you bought your new ETH for, say, $2,600, your official cost basis for that coin isn't $2,600. It's $2,600 plus the disallowed loss of $1,500. Your new cost basis is $4,100. This has massive implications. First, your tax bill for the current year is now $1,500 of capital gains higher than you thought it was. If you're in a 24% tax bracket, that's an extra $360 you owe, plus potential penalties and interest if you file incorrectly. Second, it makes your future tax situation more complicated. When you eventually sell that new ETH, your profit will be calculated from a much higher starting point, $4,100. This means your future taxable gain will be smaller, or your loss will be larger. But you've lost the immediate benefit you were trying to get. You've lost control over the timing of your tax deductions. The real danger is for high-frequency traders who were aggressively using this loophole. Imagine a trader who made hundreds of these wash sales throughout the year, thinking they had racked up $100,000 in losses to offset their gains. They file their taxes claiming a nice low tax bill. Then, a year or two later, an IRS audit letter arrives. The auditor applies the wash sale rule to every single one of those trades. Suddenly, that $100,000 loss evaporates. It's disallowed. Now, not only does the trader owe taxes on their original $100,000 of gains, but they also owe failure to pay penalties and interest that has been accruing for 2 years. A manageable tax bill has just exploded into a financial nightmare. The era of the crypto wash sale free-for-all is over. The IRS has the tools, the motivation, and the legislative intent to enforce it. Continuing to use this strategy is no longer a clever loophole. It's a high-stakes gamble against the house, and the house always wins. You are betting that your tax return will slip through the cracks, at a time when the IRS is specifically beefing up its crypto enforcement. It's a bad bet. This forces a fundamental shift in strategy. You can no longer just sell and rebuy your favorite coin. You have to be more sophisticated. You could sell Bitcoin and buy Ethereum, as they are not substantially identical. Or you could sell, wait the required 31 days, and then buy back in, hoping the price hasn't skyrocketed in the meantime. But the simple, risk-free, instant tax loss harvest is dead. Recognizing this change is the first step. But this only covers buying and selling. What happens when crypto isn't just bought or sold, but created? What are the tax implications when you earn new coins not from a trade, but from staking your existing ones, or from mining, or from a mysterious airdrop that just appears in your wallet one day? This isn't capital gains. This is income. And the way the IRS treats it is one of the most confusing and costly areas in all of crypto tax law. Let's break that down because this is where most people get tripped up. When you think taxes, you probably think of your job. You earn a salary, and a percentage of that salary goes to the government. That's your income tax. The rate you pay depends on how much you make. The more you earn, the higher your tax bracket. This is called ordinary income. When we talked about buying Bitcoin and selling it for a profit years later, that wasn't ordinary income. That was a capital gain. For assets you hold over a year, long-term capital gains are taxed at much lower, preferential rates, 0, 15, or 20%, depending on your income level. It's a huge difference. Paying a 15% long-term capital gains tax is way better than paying a 37% ordinary income tax. So, the billion-dollar question is, when is crypto treated like a stock you sold for a profit, and when is it treated like a paycheck from your job? The IRS has a simple and often brutal rule of thumb. If you receive new cryptocurrency without directly paying for it with cash, it's almost always treated as ordinary income. You have to recognize the fair market value of those coins in US dollars on the day you receive them. That value gets added to your other income for the year, like your salary, and is taxed at your regular higher income tax rate. Let's walk through the 4 most common scenarios where this happens. First, the original crypto mining. You're a miner. You use a powerful computer to validate transactions and secure the network. As a reward for your work in electricity, the network gives you brand new coins. Let's say in March you successfully mine 1/10 of a Bitcoin. On that specific day, Bitcoin is trading at $60,000. That means you just received $6,000 worth of crypto. According to the IRS, you have just earned $6,000 of ordinary income. You have to report that on your tax return, just as if a company had handed you a check for $6,000. But here's the critical second step that everyone forgets. That $6,000 doesn't just disappear into tax ether. It becomes your cost basis for that 1/10 of a Bitcoin. So now you have a taxable income event, and you're starting the clock on a new capital asset. If you immediately sell that crypto for $6,000, there's no capital gain because your cost basis equals the sale price. But if you hold it for 2 years and the price of Bitcoin doubles, and you sell that 1/10 of a Bitcoin for $12,000, you now have a $6,000 long-term capital gain. You get taxed twice on the same coin, once as income when you got it and once as a capital gain when you sold it. This same logic applies directly to our second, and far more common scenario today: staking rewards. Staking is the backbone of networks like Ethereum, Cardano, and Solana. You lock up your existing coins to help secure the network, and in return you get paid rewards, usually in that same coin. These rewards often trickle in daily, or even hourly. And every single time you receive a reward, no matter how small, it is a taxable income event. Imagine you're staking Ethereum, and you receive 0.001 ETH every day as a reward. Every single day you have to figure out the US dollar value of that reward at the moment you received it, record it as income, and also record it as the cost basis for that tiny fraction of a coin. Do this for 365 days, and you have 365 separate income events and 365 new cost basis lots to track. It is an absolute accounting nightmare. And if you're automatically restaking those rewards to compound your earnings, it gets even more complex. This is why specialized crypto tax software is no longer a luxury. For anyone who stakes, it's a necessity. Third on our list is the one that feels like free money: airdrops. A new project wants to generate buzz and distribute its tokens widely, so it airdrops free tokens into the wallets of thousands of early users. One day you check your wallet and boom, there are 500 new tokens you've never heard of. You might think it's a tax-free gift. The IRS thinks otherwise. That airdrop is ordinary income. You must determine the fair market value of those 500 tokens on the day they became available to you, the day you gained dominion and control over them. If each token was worth $2 on that day, you just received $1,000 of taxable income that you have to report for the year. It doesn't matter if you never sell them. It doesn't matter if the token's price crashes to zero the next day. On the day you received it, it had value, and that value is income. That $1,000 also becomes your cost basis. If you later sell those tokens for $3,000, you have a $2,000 capital gain. If you sell them for $100 after the project fails, you have a $900 capital loss. Finally, the most straightforward scenario: getting paid in crypto. If you're a freelancer and a client pays your $5,000 invoice with $5,000 worth of Ethereum, you have $5,000 of self-employment income. It's no different than if they'd sent you a check. You owe income tax and self-employment taxes on that full amount. If you work for a company and they offer to pay part of your salary in Bitcoin, that portion is still subject to all the same payroll taxes, Social Security, Medicare, and income tax withholding, based on the dollar value of the Bitcoin on your payday. In these cases, the crypto is just a medium of exchange for your labor, and it's taxed as such. Now, this whole idea of taxing newly created property as income is actually quite controversial. There's a famous ongoing legal battle involving a Tennessee man named Joshua Jarrett. He was a Tezos staker who received 8,876 new Tezos tokens from staking. He reported them as income, paid the tax, and then filed for a refund, arguing that this was all wrong. His argument was brilliant. He said that staking rewards aren't income upon receipt. They are newly created property. He compared himself to a baker who bakes a cake or an artist who paints a painting. The baker doesn't have taxable income the moment the cake comes out of the oven. The artist doesn't have income the moment the last brushstroke is applied. They only realize income when they sell the cake or the painting. Jarrett argued that staking rewards should be treated the same way. His cost basis should be zero, and he should only pay capital gains tax when he eventually sells the tokens. This idea sent shockwaves through the crypto world. In a stunning move, the IRS initially agreed to give him a full refund, which would have set a monumental precedent for all stackers. But there was a catch. The IRS wanted to issue the refund without a court ruling, meaning the issue would remain legally unresolved for everyone else. Jarrett, wanting to set a precedent for the entire community, refused the refund and pushed the case forward. The government then changed its position, and the battle continues in court. This case highlights just how unsettled and confusing this area of tax law is. For now, the official IRS guidance is clear. Rewards from mining, staking, and airdrops are income when you get them. But the very foundation of that guidance is being legally challenged. So, to recap this critical section, when you acquire new crypto without buying it directly, whether it's from mining, staking, airdrops, or being paid for a service, you have a two-part tax situation. First, the fair market value of the crypto on the day you get it is ordinary income, taxed at your high, regular rate. Second, that same value becomes the cost basis for your new crypto, which will then be subject to capital gains or losses when you eventually sell, swap, or spend it. It's a double-edged sword that can create massive, unexpected tax bills. We've covered the profits from selling, and now we've covered the taxes on new crypto you receive. But what about the other side of the coin? What happens when things go disastrously wrong? What happens when you sell at a loss, your crypto gets stolen in a hack, or the hot new project you invested in goes to zero? Can you use those painful losses to actually save money on your taxes? The answer is a resounding yes, but the rules for claiming those losses are a minefield of their own. Let's start with the most basic rule of the game. Just like gains, losses are split into two teams: short-term and long-term. The dividing line is exactly the same. Did you hold the asset for 1 year or less? That's a short-term loss. More than a year? That's a long-term loss. This distinction is everything because the IRS has a very specific step-by-step playbook for how you're allowed to use these losses to your advantage. Think of it like a waterfall. Your losses flow downwards, wiping out different types of gains in a strict order. First, losses offset gains of the same type. It's the most intuitive step. Your short-term losses, the crypto you bought and sold at a loss within a year, get to work immediately on wiping out your short-term gains. Let's say you made a quick $2,000 profit on a Solana trade, but you also took a $1,500 loss on a bad Cardano bet a few weeks later. Both are short-term. The IRS lets you net them out. Your $1,500 loss cancels out $1,500 of your gain. So you only owe income tax on the remaining $500 of profit. Simple. The same exact logic applies to the long-term bucket. Your long-term losses first offset your long-term gains. You held Bitcoin for 3 years and sold for a $10,000 profit, but you also sold some Litecoin you held for 2 years for a $4,000 loss. Your loss directly reduces your gain. You're now only taxed on $6,000 of long-term capital gains. But here's where it gets really powerful. What happens when you have leftover losses? What if your short-term losses were bigger than your short-term gains? Or your long-term losses wiped out all your long-term gains and you still had some left over? This is where the waterfall spills into the next level, and you get to cross the streams. The IRS allows your leftover losses from one category to offset gains in the other. So if you have excess short-term losses, you can use them to reduce your long-term gains. And if you have excess long-term losses, you can use them to reduce your short-term gains. Now, which one of those is better? Think about the tax rates. Short-term gains are taxed at your high ordinary income tax rate. Long-term gains are taxed at those much lower preferential rates. So using a long-term loss to cancel out a high-tax short-term gain is a fantastic deal. You're using a loss from a low-tax category to erase a profit from a high-tax category. That's a huge tax efficiency win. It's like using a discount coupon on the most expensive item in the store, not the cheapest. But the waterfall doesn't stop there. This is the part that blows most people's minds. What if, after all that offsetting short-term against short-term, long-term against long-term, and then crossing the streams, you still have a net capital loss for the year? Let's say after everything is said and done, you're down $5,000. Does that loss just disappear? Absolutely not. The IRS gives you one of the most powerful tax deductions available. You can use your leftover capital losses to directly reduce your ordinary income. That means your salary from your job, your W-2 income. There's a limit, of course. You can deduct up to $3,000 of capital losses against your ordinary income each year. Let's make that real. Suppose your total crypto activity for the year resulted in a net loss of $5,000. You can take $3,000 of those dollars and subtract it directly from your taxable income. If you're in the 24% federal tax bracket, that $3,000 deduction just put $720 back into your pocket. That's a real tangible tax saving, earned from a losing investment. It's the ultimate silver lining. So what happens to the other $2,000 of loss from our example? The part that was over the $3,000 limit? Again, it doesn't vanish. This is the final, incredible feature of capital losses. They carry forward indefinitely. That remaining $2,000 loss gets carried over to the next tax year. Next year, it can be used to offset any capital gains you might have. And if you have no gains, or if you still have losses left over after offsetting gains, you can take another $3,000 deduction against your ordinary income. And you can keep doing this year after year until the entire loss has been used up. A major crypto loss from one bad year can literally be providing you with tax savings 5-10 years down the road. It becomes a valuable asset on your personal balance sheet. This strategic selling of assets at a loss to create a tax benefit is called tax loss harvesting. And it's a core strategy used by sophisticated investors everywhere. But in the world of crypto, there are some very sharp, very dangerous traps you need to be aware of. The biggest one, the one that trips up thousands of people, is called the wash sale rule. For stocks and traditional securities, the rule is well known. It says you cannot claim a capital loss on a sale if you buy the same or a substantially identical security within 30 days before or 30 days after that sale. The IRS does this to prevent people from gaming the system. You can't just sell your Apple stock on Monday to book a loss for tax purposes and then buy it right back on Tuesday, maintaining your position. If you do that, the loss is disallowed. For years, the crypto world existed in a gray area. The wash sale rule specifically mentioned stocks and securities, and since the IRS classified crypto as property, the rule technically didn't apply. It was the Wild West. You could sell your Bitcoin at a loss at 10 a.m. to harvest that tax benefit, and buy it right back at 10:01 a.m. It was a massive loophole. Well, I have to be the bearer of bad news. The party is over. While not yet codified into law with perfect clarity, the IRS has made its position increasingly clear, and major tax software and crypto platforms now operate as if the wash sale rule applies to digital assets. The consensus among tax professionals is that you absolutely must abide by it. So what does this mean for you? It means if you sell your Ethereum for a loss on March 1st to harvest that loss, you cannot buy any more Ethereum for the next 30 days. If you do, that loss you were hoping to claim gets disallowed. It doesn't disappear entirely. It gets added to the cost basis of the new crypto you just bought, which complicates your accounting and delays your ability to recognize the loss. The bottom line is this: if you want to claim a loss, you have to be truly out of that specific crypto for at least 30 days. Now let's talk about another painful scenario: the rug pull. The hot new token you aped into goes to absolute zero. It's worthless. Can you claim the loss? Yes, but there's a catch. You can't just declare it worthless. You need to prove you disposed of it. You need to create a taxable event. If the token is delisted from all exchanges and you can't sell it, you might be stuck. This is why it's critical, if a coin is on its deathbed, to sell it. Even for a fraction of a cent, swap it on a decentralized exchange for 0.0001 ETH. That transaction recorded on the blockchain is your proof of sale. It's your receipt for the IRS that shows you realized a 100% loss. Without that final transaction, you have an unrealized loss, which gives you zero tax benefit. Finally, we have to address the most devastating situation: theft. What happens if your account on an exchange gets hacked and drained? Or you fall for a phishing scam and your wallet is emptied? This is where the tax code is particularly brutal. Prior to 2018, you could take what was called a casualty and theft loss deduction. But the Tax Cuts and Jobs Act of 2017 suspended that deduction for individuals. Since the IRS classifies your crypto as personal property, if it's stolen under current law, there is generally no way to deduct that loss on your taxes. It's a complete 100% loss with no tax-saving silver lining. It's a gut punch, and it's why self-custody and security are so unbelievably important. So while a market crash can be brutal for your portfolio, it can be a goldmine for tax savings. If you play by the rules, you can turn red candles into green tax returns by offsetting gains, reducing your regular income, and carrying losses forward for years. But you have to navigate the wash sale rule, properly dispose of worthless assets, and understand the brutal truth about theft. But what about the Wild West of crypto? We've covered buying, selling, and losing. But what happens when you're not just trading? What are the tax implications of staking your Ethereum, earning yield in a DeFi protocol, or minting and selling an NFT? These aren't simple sales. They're income events, and the IRS is watching them closer than ever. Let's break down these income events, starting with one of the most popular: staking. When you stake a proof-of-stake cryptocurrency like Ethereum, you're essentially acting like a mini-bank for the network. You lock up your coins to help validate transactions and secure the blockchain, and in return the network pays you a reward, usually in the form of more coins. It's a fantastic way to earn passive income, but the IRS sees that passive income as just, well, income. Here's the critical rule. Staking rewards are taxed as ordinary income at the moment you receive them. The amount of income you have to report is the fair market value of the coins on the day they hit your wallet. This is not a capital gain. This is treated the same way as earning interest in a savings account or getting a cash rebate. Let's walk through an example. Say you stake 10 Ethereum. Over the course of the year, you earn a total of 0.5 ETH in staking rewards, paid out in small increments every single day. For every single one of those daily payments, you have a taxable income event. If on January 1st you receive 0.001 ETH and the price of ETH is $2,500, you have just realized $2.50 of ordinary income. If the next day you receive another 0.001 ETH, but the price has jumped to $2,600, you've realized $2.60 of income. Yes, it's that granular. You are supposed to record the fair market value of every single reward at the time of receipt. Now, here's the second half of the equation, and this is where people get confused. Reporting it as income is only step one. That income you reported also sets the cost basis for your new coins. So, in our example, your cost basis for that first 0.001 ETH is $2.50. The basis for the second is $2.60, and so on. Why does this matter? Because when you eventually sell or trade those reward coins, you will have a capital gains event. If you sell that first 0.001 ETH a year later when the price is $4,000, your capital gain isn't the full $4. It's the sale price minus your cost basis. So, for $1 minus the $2.50 you already paid income tax on, your capital gain is only $1.50. This system prevents you from being double taxed on the same money, but it requires meticulous record keeping. This same logic applies directly to the wild world of decentralized finance, or DeFi. When you provide liquidity to a protocol like Uniswap or Aave and earn yield, those reward tokens you receive are, once again, ordinary income. The moment you claim those rewards and they are under your control, you have to determine their fair market value and report it on your tax return. That value then becomes your cost basis for those tokens when you later sell them. The challenge with DeFi is that the transactions can be fast, furious, and incredibly numerous, making tracking an absolute nightmare without specialized software. Now let's talk about the big one, the one that took the world by storm and created a whole new set of tax headaches: NFTs. Non-fungible tokens. The tax rules here depend entirely on who you are in the transaction, the creator or the collector. First, let's look at it from the perspective of the artist, the creator, the minter. If you create digital art, music, or any other content, mint it as an NFT, and then sell it on a marketplace like OpenSea, the money you make from that initial sale is almost always considered ordinary income. It's business income. Think about it, you created a product and sold it. That's not a capital investment. It's your job or your side hustle. The full sale price, minus any expenses like gas fees to mint the NFT or marketplace fees, is income, taxed at your regular income tax rate. It's reported on a Schedule C, just like any other freelance or small business work. But what about for the buyer, the collector, the investor? This is where things get really interesting, and where one of the biggest tax gotchas in all of crypto exists. When you buy an NFT and hold it, it is a capital asset just like a stock or a piece of Bitcoin. If you sell it for more than you paid, you have a capital gain. If you hold it for more than a year, it's a long-term capital gain. Simple, right? Wrong. The IRS classifies NFTs as collectibles, putting them in the same category as physical art, rare stamps, or antique coins. And collectibles have a special, much higher long-term capital gains tax rate. While long-term gains on stocks and crypto are taxed at 0%, 15%, or 20%, long-term gains on collectibles are taxed at a whopping 28%. Let me repeat that. You could pay nearly double the tax on a profitable NFT flip compared to a profitable Bitcoin trade, even if you held both for the exact same amount of time. This is arguably the single most misunderstood rule in crypto taxes, and it has blindsided countless investors who were expecting the lower capital gains rate. What about other ways you might receive crypto? Let's consider airdrops and hard forks. An airdrop is when a project sends free tokens directly to your wallet, usually as a form of marketing to build a community. A famous example is when Uniswap airdropped 400 Uni tokens to its early users. It was like free money falling from the sky. But the IRS doesn't see it as a gift. They see it as income. The moment you gain control over those airdrop tokens, you have to report their fair market value as ordinary income. For those early Uniswap users, that was over $1,000 of taxable income that appeared out of nowhere. The same principle applies to hard forks. When a blockchain splits, like when Bitcoin forked into Bitcoin and Bitcoin Cash, holders of the original coin suddenly received an equal amount of the new coin. The IRS guidance is clear. That new cryptocurrency you received from the fork is ordinary income, valued at its fair market value on the date you received it. So, if you held 10 Bitcoin in 2017, you suddenly had 10 Bitcoin Cash, and you also had a new income tax liability based on whatever the trading price of Bitcoin Cash was that day. And just like with staking and DeFi rewards, the income you report becomes your cost basis for those new coins. Finally, what if you're not just an investor, but you're actually earning a living with crypto? Let's say you're a freelancer who gets paid in USDC, or you work for a Web3 company that pays your salary in Ethereum. This is actually more straightforward. Getting paid in crypto is treated exactly the same as getting paid in US dollars. If you're an employee, your employer is supposed to convert your crypto wages to their US dollar value on your payday and report that on your W-2. All the standard payroll taxes, income tax, Social Security, Medicare, are withheld. If you're an independent contractor, you receive crypto from a client. You must record the fair market value of that crypto on the day you receive it as your gross income. You'll report this on your Schedule C, and you'll be responsible for paying self-employment taxes on it. And remember the two-part transaction. When you get paid your 1 ETH salary, valued at $3,000, you have $3,000 of income. That is your cost basis for that 1 ETH. If you immediately sell it for $3,000, there's no capital gain. But if you hold it, and it appreciates to $4,000 before you sell it, you now have a separate $1,000 capital gain to report on top of the initial income. The common thread through all of this staking, yield farming, airdrops, getting paid, is that the world of crypto is filled with events that create ordinary income, not just capital gains. And this distinction is everything. It often means a higher tax rate, and it always means a more complex tax return. The IRS is moving from a world of simple buy and sell transactions to a universe of complex, income-generating digital activities, and their expectation is that you are keeping track of every single one. And let's be honest, that sounds overwhelming. A nightmare even. How can you possibly track 1,000 tiny transactions across a dozen different platforms, especially when the rules themselves seem to be written in a language from another dimension? Well, the first step is understanding what these new, complex activities are and where the tax traps lie. So let's peel back the layers on some of the most common and most confusing crypto activities beyond simple buying and selling. Let's start with one of the most explosive areas of the last few years: NFTs, or non-fungible tokens. When you mint an NFT, you're essentially creating it on the blockchain. The act of minting itself is generally not a taxable event. However, the costs associated with it, like the minting fee and the gas fees you pay, become part of your cost basis. Think of it like a painter buying a canvas and paints. Those are the initial costs. The taxable event happens when you sell that NFT. If you sell it for more than your cost basis, you have a capital gain. If you sell it for less, you have a capital loss. It's treated just like selling a stock or a piece of art. But here's the crypto twist. What if you sell your NFT not for US dollars but for ETH? Well, that's a double whammy. You have a taxable event on the sale of the NFT, calculating your gain or loss in terms of the dollar value of the ETH you received at that moment. And now you've acquired ETH, which has its own cost basis, that exact dollar value, that you'll need to track for when you eventually sell or trade that ETH. Every transaction creates a new data point. And for NFT creators, it's different again. If you create an NFT collection and receive royalties every time one of your pieces is resold on the secondary market, that royalty income is not a capital gain. It's treated as ordinary income, just like an author receiving royalties from a book sale. Now let's wade into the deep end of the pool. DeFi or decentralized finance. This is where things get truly complicated. Let's start with staking. When you stake your crypto, you're locking it up to help secure a network, and in return you earn rewards. The IRS has been fairly clear on this. Those rewards are taxed as ordinary income. The taxable moment is when you gain dominion and control over the rewarded assets. Basically, the moment they are in your wallet and you can do what you want with them. You have to record the fair market value in US dollars of those rewards on the day you receive them. That amount is your income. But it doesn't stop there. That income amount also becomes the cost basis for those new coins. So when you later sell those rewarded coins, you'll have a capital gain or loss based on the difference between the sale price and the value you already declared as income. It's a two-step tax process. Next up, the real beast: providing liquidity to a liquidity pool. This is a cornerstone of DeFi, but from a tax perspective, it's a minefield with very little official guidance from the IRS. Here's the most conservative and therefore safest way to look at it. When you add liquidity to a pool, you typically provide two different tokens, say ETH and the stablecoin USDC. In exchange, you receive a new third asset, an LP token, which represents your share of that pool. Most tax professionals argue that this initial step is a taxable event. You have disposed of your ETH and your USDC in exchange for this new LP token. You would need to calculate a capital gain or loss on both the ETH and USDC you deposited, based on their value at that moment. Then, while your funds are in the pool, you earn trading fees. These fees are almost certainly ordinary income. You need to track them as they accrue. And what about the dreaded impermanent loss? This is a critical concept to understand. Impermanent loss is a financial phenomenon in liquidity pools, not a tax term recognized by the IRS. You cannot simply claim a deduction for impermanent loss. The loss is only realized for tax purposes when you exit the pool. When you cash in your LP token and get your underlying assets back, that is a second taxable event. You are disposing of the LP token. Your capital gain or loss is the difference between the value of the assets you receive back and the cost basis of the LP token you originally got. Any impermanent loss is simply baked into that final calculation. You might get back less value than you put in, resulting in a capital loss on your LP token, but you can't just write it off while you're still in the pool. Let's move on to airdrops. This is when a project sends free tokens directly to your wallet, usually as a marketing tool or to reward early users. The IRS views this as found money. It's ordinary income, taxed at the fair market value on the day. The tokens arrive in your wallet, and you have control over them. If you get an airdrop of 100 tokens worth $5 each, you have $500 of ordinary income to report for that year. That $500 then becomes your cost basis for those 100 tokens. If you later sell them for $800, you have a $300 capital gain. If you sell them for $200, you have a $300 capital loss. The same logic applies to hard forks, like when Bitcoin Cash was created from Bitcoin. Receiving those new coins is an income event. What about borrowing and lending? This is an area many use to try and access liquidity without creating a taxable event. Generally, taking out a loan is not a taxable event. If you own 10 Bitcoin and you collateralize it to borrow $100,000, you haven't sold your Bitcoin. You still own it. You've just taken on debt. This is a powerful strategy because you can get cash without triggering capital gains. But there is a massive hidden danger: liquidation. If the price of your collateral, your Bitcoin, drops significantly, the platform can automatically sell it to cover your loan. This forced sale is 100% a taxable event. You have disposed of your Bitcoin. And the worst part is, this usually happens during a market crash when you're already losing money. So not only do you lose your collateral, but you're also hit with a potentially massive tax bill from the capital gains that were triggered, all at the worst possible time. It's a brutal tax trap that has caught countless investors by surprise. Finally, we have the murky world of wrapping tokens and bridging assets between different blockchains. When you wrap Bitcoin to use it on the Ethereum network as WBTC, or when you bridge ETH from the main network to a Layer 2 network like Polygon, what's happening from a tax perspective? Have you disposed of your original asset in exchange for a new one? Or is it like moving cash from your checking account to your savings account, the same asset just in a different place? The honest answer is, the IRS hasn't given us clear guidance. Tax professionals are divided. The most conservative approach is to treat it as a taxable disposition and a new acquisition. The more aggressive, riskier approach is to argue it's a non-taxable transfer. This ambiguity is a perfect example of how the technology is moving far faster than the tax code. So you have NFTs, staking rewards, liquidity pools, airdrops, liquidations, and a dozen other complex events, each with its own set of rules and potential tax consequences. It's a tangled web of ordinary income events and capital gains transactions, all happening at lightning speed, 24 hours a day. The sheer volume and complexity can feel impossible to manage. So, with all these intricate and often ambiguous rules, how is any normal person supposed to stay compliant? How do you actually track all of this without losing your mind or setting yourself up for a painful audit? It all comes down to a combination of the right tools and the right strategy. Let's break that down because the strategy is actually more important than the specific tool you choose. The best software in the world won't help you if your approach is a mess. The strategy can be boiled down to a simple, 4-step process. Consolidate, categorize, calculate, and reconcile. First, consolidate. This is the foundation. You need to get a complete picture of every single transaction you've ever made. This means connecting every exchange account you use via an API key, which is like giving the software read-only permission to see your history. For wallets like MetaMask or Phantom, you just need your public address. For exchanges that don't have good API support or for wallets on obscure chains, you'll need to download your transaction history as a CSV file, basically a spreadsheet, and upload it manually. The goal here is to get everything from that first Coinbase purchase to that weird DeFi swap you did 6 months ago into one single place. If you don't, the system will have missing data, and the calculations will be completely wrong. It might see you sold 1 Bitcoin, but if it never saw you buy it, it might assume your cost basis was 0, leaving you with a massive and incorrect tax bill. Consolidation is non-negotiable. Second, categorize. Once all your transaction data is in one place, the real work begins. The software will do its best to automatically categorize everything. It'll see a transfer from your Coinbase account to your Ledger wallet and label it as a non-taxable transfer. It'll see you swapped Ethereum for a new altcoin on Uniswap and label it as a taxable trade. But it's not perfect. What happens when you use a crypto bridge to move assets from Ethereum to Polygon? The software might see it as you sending crypto out and receiving different crypto back, flagging it as a taxable event when it really wasn't. This is where you have to go in and manually review and correct these transactions. You have to teach the machine what you were actually doing. Was that incoming transaction a gift? An airdrop? A payment for a freelance gig? Each of these has different tax implications, and only you know the true context. This step is what separates a sloppy tax report from an accurate, audit-proof one. Third, calculate. This is the part you absolutely should not do by yourself. Once everything is consolidated and correctly categorized, you click a button, and the software does the magic. It applies the specific accounting method you've chosen, usually FIFO or first in, first out, unless you've specifically identified lots to use HIFO or LIFO where applicable. It crunches the numbers on thousands of transactions in seconds, calculating the cost basis, the proceeds, and the resulting capital gain or loss for every single trade. It then spits out the exact forms you need for your tax return, most importantly, the IRS Form 8949. This form is literally just a long list of all your taxable crypto events for the year. This is the document that shows the IRS your work. And finally, the fourth step, which most people skip, reconcile. At the end of the year, your crypto tax software should be able to tell you how much of each coin it thinks you have based on all the transactions it has processed. Your job is to compare that number to what your actual wallets and exchange accounts say you have. If the numbers match, congratulations, your records are likely perfect. But if the software says you should have 1.5 Ethereum and your wallet only has 1.4, there's a discrepancy. You have a missing transaction somewhere. You need to play detective and figure out what happened to that 0.1 ETH. Maybe you spent it on an NFT and forgot to import your OpenSea history. Maybe you paid for a subscription or tipped someone. Finding and fixing these discrepancies is the final boss battle of crypto tax prep. But it's what ensures your records are bulletproof. So that's the strategy. Consolidate, categorize, calculate, reconcile. Now let's talk about the tools that make this strategy possible. The main player here is specialized crypto tax software. Companies like Coinly, CoinLedger, ZenLedger, and many others are built specifically for this purpose. They are the engines that power the 4-step strategy. They provide the API and CSV importers for consolidation, the interface for categorization, the powerful calculators for the tough math, and the reports for reconciliation. For probably 80 to 90% of crypto users, a subscription to one of these services is all you really need to stay compliant. You can generate your Form 8949, and then you either import that directly into a tax filing service like TurboTax or H&R Block, or you hand it over to your accountant. This brings us to the second tool, the human element. When do you need to go beyond software and hire a crypto-savvy CPA or tax professional? Here's a good rule of thumb. The more your crypto activity looks like a complex business, the more you need a human expert. If you just bought some Bitcoin on a major exchange, held it, and sold some, software is almost certainly enough. But if you answer yes to any of these questions, it's time to consider professional help. Are you heavily involved in complex DeFi activities like liquidity providing, yield farming, or borrowing and lending across multiple protocols? Are you minting, buying, and selling NFTs as a significant part of your income, potentially as a business? Are you running a validator node or a mining operation? Did you receive crypto as payment for a business, meaning you have to deal with income tax and capital gains tax when you sell it? Did you have to deal with a protocol hack or a rug pull and need to claim a theft loss? In these cases, the nuances are just too great. A good crypto accountant doesn't just check your math. They provide strategic advice. They can help you with things like tax loss harvesting, strategically selling losing positions to offset your gains. They can advise you on the best business structure for your activities and help you plan for future tax liabilities. The software is the tool that prepares the raw materials, your transaction data. The accountant is the master craftsman who can take those materials and build you the strongest possible financial structure. So let's picture two different crypto investors to see how this all plays out. First, we have Chaos Casey. Casey is excited about crypto. He trades on 5 different exchanges, uses a hardware wallet, and dabbles in some DeFi. But he doesn't track anything. He figures he'll deal with it at tax time. When April rolls around, he's in a panic. He tries to download CSV files, but one exchange only provides the last 3 months of data. He can't remember why he sent that half an Ethereum to that random address back in May. He tries to plug what he has into a tax software, but it's a sea of red error messages. Missing purchase history. He's stressed, overwhelmed, and now has 2 bad options. File an inaccurate return and pray he doesn't get audited, or file for a costly extension and pay an accountant a premium rush fee to spend dozens of hours untangling his year-long mess. Then we have Prepared Patricia. Patricia does many of the same things as Casey, but she takes a different approach. At the beginning of the year, she picks a crypto tax software and syncs all her accounts and wallets. Once a month, she logs in for 15 minutes, grabs a cup of coffee, and reviews the new transactions. She sees a weird transaction from that new DeFi protocol and properly labels it as liquidity in. She makes a quick note about a gift she sent to her brother. When tax season arrives, her work is already 95% done. She runs her reports, sees that everything reconciles, and sends the finalized Form 8949 to her CPA. She's calm, confident, and knows her records are accurate. She sleeps well at night. The difference isn't intelligence or luck, simply having a system. And that's really the ultimate secret to all of this. After everything we've covered, capital gains, cost basis, airdrops, NFTs, staking, the single most important takeaway is this: being a responsible crypto investor in the United States means being a good bookkeeper. The tax concepts themselves aren't rocket science. They're the same property rules that have existed for decades. The challenge is the sheer volume and complexity of the data. But you can handle it. You've made it to the end of this guide. You now understand the fundamental principles that govern this entire system. You know what a taxable event is. You know the difference between long-term and short-term gains. You know how income and capital gains are treated differently. You have the knowledge to avoid the common pitfalls and to build a system that works for you. The promise of cryptocurrency is the power of self-sovereignty, of being your own bank. But that power comes with responsibility. And in the current world, that responsibility includes navigating the tax system. It isn't the most glamorous part of crypto, but treating it with respect is a sign of a mature investor and a maturing industry. It's how we build a bridge from this new financial world to the old one, ensuring its legitimacy and longevity. So don't wait for the panic of next April. Take the first step now. Pick one of the tools we talked about. Many have free versions to get started. Connect just one exchange. See your transactions appear. Categorize a few. For the first time, you might see a clear picture of your portfolio's tax liability emerge from the chaos. Take that first step from being Chaos Casey to being Prepared Patricia. Your future self and your peace of mind will be profoundly grateful.